What's up, everybody? It's Rashad. I am a full-time options trader, and I bring in multiple six figures a year trading options in the stock market. And today I want to talk to you about a little-known option strategy that I utilize on the regular called covered strangles. So a covered strangle is an option strategy that you utilize to profit from a slow and steady rise in a stock price and to minimize the cost of a long call. Now, options have been amazing to me for many years. I have a family of 8. Yes, I said 8. And options have allowed me to provide for every single one of them and to make sure that none of them ever has a need that is not met. But ultimately, it has allowed me to buy my freedom back and has given me the ability to do what I want, when I want, with who I want, for how long I want. So I'm going to talk to you today about covered strangles. It is a option strategy that I utilize pretty often, and I actually have a trade going on right now, so I'm going to tell you all about it. So what exactly is a covered strangle? It's a mildly bullish strategy where you buy a call and then sell both a call option and a put option with different strike prices with the same expiration date. So here's how you would place the trade. So you will first buy a call. And typically with this strategy, you're buying a call that is very far out, typically a year or more. You can do less, but I typically go as far out as I possibly can. So when you buy a call, it is very similar to owning a stock. The more that stock price goes up, the more money you'll make. Then secondly, you'll sell a call on that same exact stock. Now, this obligates you to sell the asset at the strike price if the option is exercised by the buyer. So let's say if I owned ABC stock and I bought it at $80 and I sell a call at $100, well, if that stock price rises up beyond $100, I have to sell it at $100. That's what I agreed upon. So that is selling a call. Now, thirdly, to finish out the covered strangle, you will sell a put. Now, this obligates you to buy the stock if the stock price drops below your strike price. So with the same exact example, if I had ABC stock that was currently at $100 and I sold a put at $80, if the stock price were to drop below 80, I am obligated to buy the stock at $80 no matter how far it's dropped. So those are the 3 steps to entering into a covered strangle. You want to buy a call, you want to sell a call, and you want to sell a put. So this is how a covered strangle would work. So let's suppose we have ABC stock trading at $50. First thing you'll need to do is buy to open a call. Now, typically I buy a deep in the money call. So for this example, we'll say we bought a call at $47 for 24 months out from now, and we paid $7.25, which would be $725 because you always multiply by 100, since there are 100 shares in every single contract. And then you'll simultaneously sell to open a call at somewhere above where the stock is trading currently. So in this example, we used the strike price of $55 and we picked a more near-term expiration of just 1 month out. Now for this, you receive 75 cents, which would be $75 received. And then the last step will be to sell to open a put at somewhere below where the current stock price is trading. So in this example, we did $45 and we do it for the exact same expiration as the sold call. So 1 month out, and we received 75 cents as well, which is $75. So altogether, we will pay $725 up front for the call, and then we will receive $75 plus $75, which is $150 for the 2 short puts and calls. Now, your hope in this strategy would be that the stock just continues to slowly increase over time. So if the stock price is currently $50, we want it to be right around $55 at the expiration date of these 2 short puts and calls. Because in that case, as long as the stock price is still under $55 by this expiration date, you get all of that money that you received and you get to keep your long call, and then you can just continuously sell another call, sell another call, sell another call, and continue to receive money. And hopefully by the end of this 24 months here, you will have received so much money from selling puts and calls on this stock that it will have actually paid for itself, or sometimes maybe even made money from it. So here I have the P&L chart for PayPal pulled up, and I put in a covered strangle. So here, down here, we can see I did 5 contracts for everything, and I bought a call, a long-term call at $55, and I sold a call at $70, and I sold a put at $60, okay? The current stock price for PayPal is $64.73. So if we pay attention to this blue line, the blue line shows you the value of this trade at the time of expiration of the short puts and the short call. Now down here, this x-axis is the stock price, and then over here, the y-axis is the amount of money. So here is the current stock price. So as it goes up, you can see down here in this bottom left is the amount of money you either make or lose. But stock price is currently here. And if we go all the way up by the expiration date, right at $70, where we have our short call, we will have made $1,861 in that short amount of time. Now, if for some reason the stock were to skyrocket within the time frame, you can see you start making less, slightly less, not too much, but you make less. Now, what you don't want to happen is if the stock price were to tank and then you start losing a ton of money. So this strategy is best done on a stock that you really like, that you think is going to continue to grow, but just slowly increase every single month. All right. So since we had our short call at $70, best case scenario is that on the expiration date, 30 days from now, that is just 1 penny under our strike. Let's say $69.99, and then we can set another strike higher. So here are the 3 possible outcomes that could happen if you put on the covered strangle trade. The first outcome is if the stock price were to stay between the $45 and the $55 strike price. And in this case, both the call and the put options expire worthless, and you keep the premiums from selling both options. Okay, so you'll still own the call that you bought at $47 strike price, but you've made money from the sold put and the sold call, and then you can continue to do the exact same thing over and over again. The second outcome is the stock price rises above the call strike. And in this scenario, the call option is exercised, meaning you must sell your shares at $55, which might limit your profit potential on the upside, but you keep the premium received from selling the put option. All right, so since we sold the call at $55, if PayPal stock price rises, let's say up to $65, we don't get any of that money from $55 to $65 because we already agreed to sell the call at $55. However, you do keep all that money that you receive from the time you bought the stock and its rise all the way up to $55. And now the third and least favorable option would be for the stock to drop below your $45 strike. And in this case, the put option is exercised, which means you must buy more shares at $45, which could be unfavorable if the stock price has dropped significantly below $45. But you keep the premium received from selling the put option. So with a covered strangle, you do want the stock price to continuously rise, but you just want it to rise very slowly. And that is why this is a great strategy for a company like PayPal, because they have dropped so much over the last few years. However, their revenue, income, and free cash flow has grown, even while the stock price has dropped. So now, at least I believe that PayPal is undervalued, and I do believe that it will continue to slowly rise over the next several years. So quick review, what are the pros and cons of the covered strangle? First one is obviously income generation. You collect premiums from both the call and the put options. And hopefully you also make money from the long call from the stock continuously rising slowly. Secondly is the reduced cost basis. Premiums received can reduce the effective cost basis of the underlying asset. So as I said before, since you are receiving money from the sold call and the sold put, it helps to kind of reduce the amount that you pay for the long call over time. Now, what are the cons? Well, you have unlimited downside risk. If the stock price falls significantly, you could incur substantial losses since you might have to buy more shares at the put strike price. And lastly, you have limited upside potential. If the stock price rises significantly, you might miss out on potential gains because you are obligated to sell at the call strike price. So as a quick recap, the covered strangle is typically used by traders who have a neutral to slightly bullish outlook on the underlying asset and want to generate additional income from option premiums while holding the asset. It requires a careful management and an understanding of the risks involved, particularly the potential for significant losses if the underlying asset's price moves sharply in either direction. All right, so in full disclosure, I am currently in a trade with PayPal doing this exact strategy, the covered strangle, but feel free to use this option strategy on any company that you think may slowly increase over time. But if you'd like to learn more about how I make full-time income trading options, feel free to join our Trade to Freedom community. Within this community, you'll be able to see my exact trades in real time. And not only that, you'll get a full A to Z options course for free. The link is in the description below. I hope to see you guys in the community. I'll talk to you soon. Peace.